Hello and welcome to our webinar on an introduction to charity investments. My name is Tracy Bird and I run the SCVO Trustee Network, which is sponsored by Rathbones, who are one of the leading charity investment managers in the UK. We're really grateful for the support that Rathbones give the Trustee Network, and they've got some great resources on their website for charities, which I would encourage you to check out. I'll put a link to that in the chat. So we have with us today Fiona Gillespie from Rathbones, and she'll be providing an overview of the reasons why charities should consider investment, and we'll be looking at the impact of inflation on cash in the bank right now when times are extremely challenging for our sector. We really appreciate you joining us today, and just to note that this webinar is being recorded and will be available later on the SCVO website. We'll also send out the slides from today and links to further resources in a follow-up email. Do use the chat as we go to ask questions, and we will have time to cover these at the end. So that's enough from me. Thank you. And now I'm going to hand over to Fiona for her presentation. Thank you.
Thanks, Tracy. I'm going to check you can see the screen, Tracy. Can you still see my slide deck sitting up there? Perfect.
Yes, that's fine.
Thanks very much. Well, a very warm welcome to everybody, and I hope you're all well. And many thanks to SCVO for having me present to you this afternoon. If you see me glancing away from the screen, please excuse me. I've not managed to get my slides and all of your little icons on my one screen, so I may glance away from time to time. Rathbones, as you know, are sponsoring the SCVO Trustee Network this year, and we are on hand for anyone to get in touch. Should we be able to assist in any way, especially if you're considering investment for your organisation or just looking for some advice and direction, please do get in touch with us. The session I'm going to focus on today is one in a series of webinars we have on our website, and you can listen to those at your leisure. And we'll also be bringing some of those events to SCVO in the coming months. You'll also find details of future trustee training events, which you're very welcome to sign up for. In fact, we have one in our Edinburgh office next week, and I shall give you details of that at the end. So by way of introduction, oh, and I need to move my mouse. Let's get us organised. There we go. So by way of introduction, I'm Fiona Gillespie. I'm an investment director in the charity team and head up the Scotland team for Rathbones across Edinburgh and Glasgow offices. And we look after portfolios for around 500 charities, so quite a number. As Tracy pointed out, we will send a copy of these slides to you, but please do add questions into the chat and we shall try and deal with them as we go along. If not, I shall take on some of the questions at the end. And if there's anything that we can't cover, I can always get in touch with somebody specifically who would like to have an answer. So without further ado, let's crack on. I've quite a lot to cover. So the agenda that we're going to look at today is why would you invest? And if you were to invest, which type of investments might you see crop up in your portfolio? We'll go through a bit of a bird's eye view of the different asset classes. And then we'll briefly finish just on how we look at things when we're constructing and putting portfolios together for our clients. So why would you either consider investing in the first place? Well, remembering as trustees, you do have duties with regard to generating a fair return on your surplus funds that you have within the organisation. You almost have three key decisions or three options. The first one is you can do nothing. You can sit with your cash in the bank, but as we'll see, that has implications, not least for the rate of return you get, but also how inflation really has a hit on that option. Second, you could spend it, although this can become more complicated, especially if you're a permanently endowed organisation. And also you have to be considering how long you want to be in existence. How quickly will that money run out? Or you can invest it. Investing to generate an income, hopefully grow the value in line with inflation over time, if not above, and potentially provide benefit from your organisation to your stakeholders in a more sustainable fashion. So I mentioned inflation, and very topical in these times. I'm not sure we can get through a day or a news bulletin without inflation being mentioned. But it's very relevant when you're sitting on cash in the bank. And we all know the impact of that. But sometimes we can forget the real power of that inflation and how it can be depleting value over time. This chart has some simple examples to illustrate that point. So examples on how prices have moved since 1973. So if we take the first column, effectively put your cash in a biscuit tin and sit it under your mattress, when you come back however many years later, almost 50 years later, you'll still have £10,000. If we look at this in context, if you were to buy a detached house in 1973, you may have paid around about £17,000. The value of that asset has gained almost 20 times in that period. Similarly, a loaf of bread is up 8 times, and so on. So you can see the impact of inflation in terms of the future value of any money. Now let's turn this the other way around and look at the erosive power of inflation. So if we take £2 million and see what it's worth in 20 years, using different rates of inflation. So at an average rate of 2%, which is the magic number the Bank of England actually are targeting, that would fall to £1.3 million at the end of that 20 years, effectively a third of the value being eroded. This is assuming inflation stays at that level, and there's lots of assumptions here, but it just gives the impact and it tells the story. If you move along to 10%, which is where we are closer to now, that falls to 243,000, or 90% of the value. However, even the most pessimistic of us would consider the current situation ensuing for 2 decades to really happen. But say this just proves a point, that erosion of value as you keep your money under the mattress, not doing very much for you, doing nothing for you. Inflation is often called the thief in the night. If you don't continue to grow your assets ahead of inflation, you'll steadily be worse off as the years go by. So taking this another step, and let's build into the fact that you want to spend over that time. So if we have £2 million and we want to spend £50,000 a year, let's assume inflation is at that magic number of 2%, then we get a double hit, both from inflation and from expenditure. We're asking our money to do an awful lot for us. And you can see from the chart, that sort of greeny line, or the sort of, I'm not sure, browny green line, that if you're doing that, you'll effectively run out of money in 23, 24 years. If you put it in the bank, and let's assume, just for illustrative purposes, you get 1.2% in cash, and you still have the same expenditure, it lasts a few years longer, maybe out to 26, 27 years. However, if you invest, and let's take a rate of return of 7 to 8% per annum, this shows you have a much better chance of growing the value of your assets ahead of inflation, even with your spending pattern. Now, I know this doesn't take into account the volatility aspect, and that assumed returns may be optimistic, but hopefully you get the idea. So where can you invest? These are the main asset classes, most of which we'll touch on in some more detail. This slide is quite crude, but we're trying to show where the main asset classes sit on a risk-reward trade-off. So the higher the risk you're taking on the left-hand side, the expectation, the reward is larger along the bottom axis. So cash, as we mentioned down at the bottom, with lower returns, but low risk, moving up to gilts, which are government bonds, which are textbook low risk. And I say that very much with inverted commas, and we'll actually think about whether that's the right categorization shortly. And clearly the news that we're seeing just now would tell you otherwise. And then going up the risk spectrum to corporate bonds, infrastructure, property, perhaps should be maybe higher in terms of risk in some market environments. And then we go into equities. And last on this chart is private equity, which can be much higher returns, but with that comes much higher risk and volatility. So we're going to step through one or two of these and just delve into more detail. So cash, we're starting at that bottom left-hand corner. Cash and bank deposits, fixed deposits and overnight deposits, you may get slightly higher rates for fixed, but certainly not beating inflation, well, not at the moment. And while rates are rising, you'll see that banks are not so generous in putting rates up as the Bank of England raises rates, as they are to cut them when the Bank of England cuts rates. There's definitely an asymmetric pattern going on there. In terms of pros and cons, generally, your money is easily accessible. Clearly, you need to hold cash for your overall operations and near-term commitments. Also, are realisable reserves according to your policy, say 6 months operational costs. You do get some income, not very much, and you can get a degree of protection with the Financial Services Compensation Scheme. So that effectively protects £85,000 of deposits in a UK bank, and I stress a UK bank. But the returns are low, especially in relation to inflation. And you can lose capital should the bank fail outside of the UK. In fact, if you have more than 85,000, you can lose capital within a UK bank because your 85,000 is the guarantee. We saw this happen quite a lot during 2008 in the financial crisis. If you recall back to then, many Icelandic banks were around the market offering very high rates of deposit. And I certainly know a few organisations and individuals who made use of that high rate and came into difficulties as those banks failed. It doesn't happen often, but we have seen banks fail. If you are holding cash, it's worth diversifying that as much as you can across a number of banks to mitigate that risk and maximising your deposit guarantee. The key downside of cash, like I say, is the erosion of inflation that we've just talked about. So moving on to fixed income. There are various interchangeable words that can be used to describe fixed income. It can also be known as fixed interest, fixed income, or simply bonds, but they're all effectively the same thing. And in many ways, it's the least understood asset class, perhaps the most complex, and you do need a certain amount of maths knowledge in order to keep track of all the different terminologies and the calculations that go on. But we'll try to give you a general rule of thumb and some general points to think about. So a bond is effectively a loan where investors are lending money to a government. If it's in the UK, it's known as a gilt. If it's in the US, we call it a treasury. Or it could be a corporate, so you're lending to a company. So the government or the company then owe you money. Now, if I lend you money, then I can't sell that one to anybody else. I owe you money, you owe me money, whatever way around we do that, it's a fixed agreement. In the case of a bond, you can go into the market and sell those to another party. Now, there's two types of payments when you hold a bond. You receive the coupon. Think of that as your interest you would get from the bank, generally paid twice a year. And the principal is the original loan which you issued, and that you get that back at the end. So we'll look at an example to put this into life. So bonds tend to be issued at a price of £100 or 100 pence. 100 is the par value when a bond is issued. And they're redeemed at £100 at the end of the maturity. So let's say we have a 4-year bond. In the initial investment, you give the company or the government £100, and at the end of the term, you get your £100 back. In the meantime, this is a 3% bond. So in the meantime, every year, you're getting £3. So over the lifetime of the bond, you've received £112. You've received 4 coupons of £3 and you've got your £100 back. So your return is £12 over the year. But clearly, as I mentioned, bonds can be traded. This is assuming you just buy it and you hold it to the end of its life. And investors can buy and sell in the market during the lifetime of that bond. And because of that, the price will fluctuate. And while the coupon payment will always be £3, clearly that as a percentage that will change. So we're in the secondary market and we're buying a bond at 90p, not at 100. We still get our £3, but clearly that's a higher percentage. And the other way around, if you bought the bond at 110p, when you get your £3 coupon, that's a lower percentage. Now, most bonds have a life of longer than 4 years. The example here is really just for an illustration. For example, in the UK, you can have a bond that's up to 35 years. And so the prices will change over time for various reasons. And the general rule of thumb here is that, as the example of the 90p or 110, as prices fall, the yield, the percentage value of that £3 coupon rises. So this chart shows you here as bond prices rise, bond yields fall, and that's the general rule of thumb when you're looking at bonds. So what would influence the price of a bond over time? Well, there's 3 key factors. I'm not going to go into the detail of all of these, but merely to give you the key names here, the key principles here for your knowledge. But we do have some further information on our webinars online if you want to really get into the nitty-gritty and the maths behind everything. But I'm not sure for Wednesday lunchtime we really want to go into lots of mathematical theories. But essentially, things which factor price and therefore the yield of a bond, the riskiness of the borrower. If you're going to lend to somebody or something, a government or a company, who are maybe less likely to pay that back at the end of the year, you're going to want some extra return from that. So the coupon will be higher, the yield will be higher. If during the life of that bond, let's say the UK government's a really good example, over 35 years, a lot of the headlines today are about how creditworthy is the UK after the big tax reductions last week. They could be seen to become more risky, and therefore the market and investors will demand a higher yield. And thinking back to our previous chart, your price then falls, so you're not getting as much in terms of return. The expected rate of inflation and interest rates. This is exactly what we're seeing now. So the rule of thumb here is inflation is driving interest rates higher, and we're seeing that right now. That in turn drives bond yields higher, which in turn causes bond prices to fall. So you're losing on your capital you've invested in that bond if you don't hold it all the way to the end of its life. As an example, a 10-year government bond in the UK at the beginning of this year was trading at a yield of 1%. Today, it's trading at 4.5. That is an awfully large move, and that is on the yield. So the price underneath has fallen. If you bought that bond on the 1st of January and you hold it today, you've made quite a stark loss on that investment. And thirdly, the time until the bond matures, that will also influence the yield. So pros and cons, if you like, of the fixed income market. So you're getting a predictable income, but it's fixed. That coupon is not changing. It's a fixed income and it can be eroded by inflation. Textbooks will have you believe that bonds are a diversifying asset. So if equities were to fall, bonds should save the day and should give you a good return. We haven't seen that this year. And it hasn't really been the case since about 2008, to be honest. Going against bonds are the issuer could default. They're not without risk. Inflation erodes the real value of the income that you are required or you are receiving. And the capital growth can be quite limited. So it's quite a complex asset class and very much in a period of change, I would say, certainly over the last 15 years or so, with the way markets have been have been behaving. The next thing we're going to move on to is equities, and these are likely an asset class which more people will be familiar with, and any investment portfolio, this will be the main driver of the returns over the lifetime of the portfolio. And you probably like to have most people will have come across equities. But what is an equity? An equity can also be called stocks and shares, is probably the other phrase that you will hear them being labelled by. And by holding an equity, you own a small part of a company along with a host of other shareholders. As a shareholder, you have various rights. You can go along to the AGM and you can vote on different resolutions, as they're known as. And the company will give you a list of items up for debate, up for renewal. So, for example, they will vote to reappoint their auditors. They may vote to make changes of their strategy. They may vote to acquire a company or be acquired themselves. But not always. Sorry, you receive a dividend payment similar to a coupon, but not always. Not every company gives you a dividend payment, but you can receive a dividend payment, and then obviously the share price moves on the stock exchange. So you have two sources of returns as an equity investor. Dividends are paid each quarter, and the gain you get on the share price is when you buy, the difference between your buying and selling of the asset. Dividend is much like the coupon you receive from the bonds. It's expressed as a percentage yield, so as a percentage of the price. And the chart on the left shows you that the equity market has a yield. This is actually a little bit old, it's end of 2020, had a yield of around about 5%. And the second chart just gives you a sense of how share prices can go up or down. That's very much a bottom left to top right chart, but you still have some significant periods of volatility within that. So what exactly is a dividend? So a dividend is when a company pays some of its profits to the investor. Profits typically after all costs, so operating costs, any borrowing costs they may have, and once they've paid all their taxes. Not all profits are paid out. The company may not pay dividends at all, or they may pay a portion of their profits in dividends. They may choose to reinvest in the business, or they may choose to save some back to smooth the dividend profile over a number of years. So keep a reserve, if you like, for when years are not so fruitful for them. And smoothing gives you a bit more predictability as an investor, a little bit more safety net, that you know that income that they're paying can be repeated over a period of time. So why invest in equities? Well, over time, they have proven to provide superior returns to bonds and UK gilts or UK bonds. So you can see the returns here. Let's just take, this is to the end of 2021. If we were to look at 10 years, almost 5%, gilts 1%, and cash has been in negative territory. But it's not without risk. We have had three very clear instances where stock prices were markedly lower. And I guess we can add 2022 to this list almost, although we're not quite sure where the bottom is going to be. We've not finished the year yet. But certainly for overseas markets, this year we've seen falls of up to 30% or more in some of the US markets. In the UK, we've been relatively lucky. And since the beginning of the year, UK stock prices have fallen by around 10%, quite a differential. But the reason for that has been that we have very large allocations in our index and the FTSE market to oil and gas companies. They're roughly 10% of the UK stock exchange. And so they've been enjoying a very fruitful year and therefore mitigating those losses against some of the indices in the US where it's very technology company heavy. The NASDAQ may be one that you've heard of, and that has had a very, very torrid year so far. But even though we have these periods of downturn, and it's difficult when you're in the middle of them to be awfully positive, time horizon is very crucial when you're investing in equities. Now, this chart here is telling you that if you were to invest for 10 years, and each of these data points is a monthly 10-year return, there's only been 8% of months since 1956 that you've been in negative territory. So having that long-term horizon, you can ride out the storms as they come along. And that's a really important point in any decision to be stepping into investment markets, is understanding your time horizon. So what are the pluses and minuses of equities? Well, equities do provide attractive long-term returns. Returns typically ahead of inflation. So they're what we're calling preserving the real value of your assets. They're positively impacted by economic growth and improving investor sentiment. So as economies grow, we tend to see equities beginning to pick up. So it'd be interesting to see what the next year holds, as we certainly have lots of doom and gloom headlines around where the UK economy could be. And dividends can be relatively predictable. In some cases not, but generally you get some predictability in terms of the company's ability to keep paying those dividends out. But it's volatile and it's risky, and very much impacted by inflation over the short term, as we're seeing just now. And in some cases, 2020 is a good example, when dividends were cut during the COVID crisis. Companies just stopped paying dividends because they weren't really operating. And in actual fact, within the banking sector, the regulator stepped in and said they shouldn't be paying dividends to shareholders. So there are situations where dividends can be quite markedly cut. But I'm sure I'm not the only one hoping that what we've been through in 2020-21 is not something that we're going to see again anytime soon. So moving on to some of the other asset classes, commercial property you will see in some portfolios. Now, you can invest in residential property. There are vehicles which you can do that, but it's more common to invest in commercial property. And there are 4 principal sectors, all of which have their own nuances. So offices is the first main sector that you will come across. Now, values in the office sector have clearly been impacted by COVID and the demand for office space as we work out what does our hybrid working really look like. And while you may have demand for offices artificially picking up, it's really because people are downsizing. And so there are transactions going through, but they're going to smaller buildings. So the stock of office property is likely to be too large for what we really need at this current time. And as our working habits change, one thing to be taken into consideration when you think about investing is what is the role of office within that investment. In the retail sector, some are losing, some are gaining. So clearly high streets and shopping centres to a degree, with the onset of e-commerce and online shopping, you can see yourself our high streets have plenty of empty tenants, empty spaces, empty units rather. And so demand and prices and values of high street property have very much been falling. But who's been benefiting from that? That's been the retail warehouses. And in that category, think of large distribution hubs like Amazon and the like. They're the ones who have been finding life much more buoyant than your typical high street trader. And then within industrial, that can be a real mixed bag, and very different things will drive returns in this area. Very much dependent on the use and dependent on the location. So one overarching asset class under the heading commercial property, but lots going on underneath in terms of which part of commercial property do you want to invest in. Typically, the role of property within your portfolio is to generate some yield. Yield is really coming back to this payment every quarter or 6 months, and it'll be linked to what the rent is being paid on those individual properties. It can be very stable, And importantly, it's often got some inflation protection, because the rental contracts for Amazon, for example, will have an annual rent review which will be linked to inflation. So as an investor receiving some of that rent to you, there is an inflation element already added into it. As tangible asset, it has a real value. It can be sold if the company doesn't do particularly well, or the investment vehicle in something happens to that. There is a tangible asset that has a value that can be sold. And it tends to behave very differently to equity markets. Has a relationship to bonds, but very much different from equity markets. On the negative side, rents can fall. Companies and tenants can go bust and not pay their rent. Capital values can fall. So you can have some leases expires and they maybe cannot replace that income. You then have costs in terms of transactions, and you have costs in terms of refurbishment. As I say, it's an interesting sector right now because I think there's some real structural changes happening there, not least from the office side, on our working habits and our spending habits in terms of the retail side. Infrastructure is another asset class, often in portfolios to provide income. So those charity organisations who can only spend their income, these are really important asset classes for you, because this is where you can generate the income. And infrastructure is defined as the basic structures and facilities that we require for our country to operate. So typically two sectors here: social infrastructure, that can be schools, hospitals. Economic infrastructure can be toll roads, wind farms, solar farms. And as an investor, you are, again, like property, you are receiving an income stream related to those rental payments. Often have an inflation protection. So another important point in these environments. Could be toll roads, offshore wind farm, we've got lots of examples, energy storage, for example. And this particular asset class tends not to be so linked and related to economic activity. So where we see economies go into reverse, or we see recessions, many of these investments still tend to perform reasonably well because they don't have a link to the cyclicality of the economy. And this is some further information on the types. So PFI and PPI, we'll all have heard of those as government-backed projects, and the government effectively are paying the income to investors through that mechanism. So stable and attractive income stream, often government-backed, PFI and PPI, so a degree of certainty, not like commercial property, where the tenant can shut down and go off into the sunset and not pay their rent. Some inflation protection, definite portfolio diversification. They behave very differently to equities, for example. We have, on the downside, seen disruption from COVID. These assets are quite limited in being able to get hold of them. There's high demand, therefore prices can be relatively high compared with the underlying value of the assets. And some of the vehicles that you would use to invest in infrastructure can have high levels of debt. Not everybody, not everyone, but that's a factor obviously to be considering when we're in rising interest rates, when we're investing in this sector. Now, commodities is another, maybe less well known in terms of it being a real place to invest. And some of the assets you may find in here, agricultural and livestock, quite unusual for us specifically to invest there. Precious metals is more usual. Gold is often thought of as a safety asset when inflation is running particularly high. Within the energy, you have oil and gas, oil price, and you have all sorts of other very esoteric. You can invest in orange juice, you can invest in hogs, you can invest in rice, you can invest in all sorts of different commodities, some obviously more speculative than others. They can be very volatile, and it's a very esoteric group of assets, and they all vary in terms of how they how they perform and what drives them. Gold is probably in the forefront right now with inflation ticking higher. It does provide a degree of safety in times of economic uncertainty, gives you some inflation protection, and does behave differently to other assets, and therefore you get diversification. But you get no income. It's really difficult to value gold, and returns tend to be fairly low. Hence, we tend to hold some gold in portfolios when other assets are falling. So relatively, it's doing better. Now, trying to bring all of that together in terms of how you put portfolios together, we look at the investment world in three different areas. So liquidity is this green section, and that's predominantly where you'll find the cash and the government bonds that we spoke about at the beginning of the session. Within the purple section, the section is equity type risk. This is the real engine of your portfolio that over the long term is really working hard to generate your returns. And in there are going to be your equities, some commodities, those ones which really rise and fall with the economic cycle, and some more risky fixed income investments, such as investing in emerging market economies and companies who are more risky and provide a higher return. They're all lumped together as those riskier assets, but providing you with a longer term higher return. And then we have what we call diversifiers, things like gold, infrastructure, and some property funds are in there, behaving very differently to the purple section. So I often think of this slide as your purple section doing all the work, and your green and your red are your stabilizers, trying to dampen down the volatility of your portfolio. And depending on what you're trying to do with your assets, what return you are looking for, and indeed how you can withstand those rises and falls in values, will determine the portion of these three baskets, if you like, within your portfolio. And it's all about managing risk and how these asset classes behave similarly or otherwise to each other. You don't want all your eggs in one basket. So everything rising and then everything falls. You want to have some diversification. That's where I'm going to finish for now. Really a very high level bird's eye view, and maybe gives you a couple of rules of thumb to think about. If A, you're thinking of investing, B, you do, and you are reviewing your managers, or they're coming to report to you on a quarterly basis, you may hear some of these terms. And I'd just like to, before we jump into questions, if anybody has some, please do put them in the chat box, that we will have a trustee training session in our office on George Street in Edinburgh. And we're going to have our in-house investment strategist, if you like, talking there about markets and what's happening right now. And we'll be joined by some other speakers from external firms to talk on various subjects around law, around financing, some reserves and risk management. And we have John from SCVO, who's coming to talk around all things cybersecurity, which will be quite interesting. So a mix of topics there. So our details are there, but next Thursday, I think that is, at 3 o'clock, please do register if you're interested in coming along. Be more than happy to see some new faces there. I'm going to try to unshare my screen, which is, let's see if I can do that. Has that stopped, Tracy?
No, you can still see your slides, Fiona.
So resume share, stop share. It's that stop button rather than pause.
Yes, that's it. Thank you. Thanks,
you.
Fiona. That was great. Yes, do put some questions in the chat if you have any. I've got a couple, but just before I ask one, as Fiona highlighted earlier, SCVO member organisations can access a free one-to-one session with Fiona, and we'll put a link in the chat for that one. So I'm going to ask Fiona. I'm on a board myself, and we don't have a lot of money, but we do have money in the bank. So there has been some discussions around, should we be thinking about investment? So I'm just wondering if we were to tie up, well, first of all, how much do you need to really make an investment? We maybe have 100,000, 150. Is that too small an amount?
So I think the answer to that, there's often a home for all amounts of money. There's just different ways that you would go about investing that. So what I've talked about today, or applies to both actually, when you speak to investment managers, you typically will have them build a portfolio just for you, just for the requirements that you specifically need. The other option is there will be what I would call off-the-shelf options. So these are funds. You can go and buy an investment in a fund along with all sorts of other people, and you'll know what that fund is determined to do, its objective is to do. And that is more suitable if you're looking at maybe less than £250,000, tends to be much more cost effective. So I would sort of say, in terms of Matthew's question, you can invest at any level. It's the way in which you do it. And it's also considering, are you happy that that money that's invested in equity markets, which mostly it will be, are you happy with a long-term time horizon? But there's different routes into investment for different sizes of portfolios.
Okay, so for instance, the charity, as I say, that I'm involved in, we're looking to maybe potentially purchase property. So that would it not really be a good idea then to tie up or cash that we have? I would
say if you need to have that cash available within the next 5 years, I think that's verging on sort of the lowest time horizon.
Right, so about 5 years you need to put your money in.
I would say that, especially in the way markets are right now, because if we continue to have poor returns, you want to have a long enough time period to make any negative gap up, if you like. So typically we would guard against or advise against clients thinking of less than 5 years for investing.
Okay, yeah, that's useful to know. And you've gone through all of these different asset classes. Would someone coming to you to invest money, would they have to have that kind of level of knowledge, or would it just, here's my money, do what with you will?
Exactly right. So we work with clients to understand what they are trying to do, what they're trying to achieve. And if you remember the last slide with 3 different baskets, if you like, of different asset classes, as we have that conversation and we understand what the requirements are, we then choose the balance of those 3 asset classes to meet the requirement. So what I was trying to do today is not scare people into thinking, my goodness, if I don't know all of the details of everything, I shouldn't be investing. But it gives you a bird's eye view of having that conversation and a little bit of knowledge and education. So if I was sitting talking to you, Tracy, and you were happy to invest for the long time, and you have a very high requirement on what income you need your portfolio, I might be talking to you quite a lot about infrastructure and some of those asset classes, because that's where we can get some good levels of income. But it just gives you some familiarity with some of the investments that if you were speaking to an investment manager, you will come across.
Okay.
We've got a question popped into the box. What are the cost fees? Presumably they become more impactful in times of low yield. Absolutely, and they do become more impactful in times of lower yield and lower returns, because your fees are effectively fixed. So investment management fees tend to be a percentage value of your portfolio. So you can see that if your returns are lower, more of your assets are having to, so you have fewer assets with which to pay your fee. Sorry, I didn't explain that very well. So typically you'd have a fee which would be fixed on the value of your portfolio. And most asset managers, they will have it tiered. So it may be under £1 million, the fee is X, 1 million to 5 million, the fee is a little bit lower, and above that, the fee is a little bit lower. But yes, definitely something to consider. In times of low yield, especially if you're focusing much more on lower risk assets where your return is going to be lower.
There's another couple of questions.
Yeah, short-term investment types that would be better option than sitting in the bank. One we get asked quite a lot, and it's quite a difficult question to answer because it goes back to your time horizon. So if you're thinking that you're looking for a ready realizable investment like a bank account is, there is very little that will substitute that in terms of accessibility. And this is where it's exceptionally frustrating that banks don't keep up with the Bank of England on the way up in terms of interest rate rises as they do on the way down. So that question, Hester, is very much around time horizon, first of all, to really get to grips with what options would be there. But there are a few things which look like a bank and act like a bank, but give you more than a bank. It's quite difficult to find that.
Yeah, that makes sense. Thank you.
We have another question, which I would just quickly read. When looking at a risk and personal investments, you can profile a mix to suit an individual attitude to that risk. How does this work for charities? Interesting. Yes, so the first rule of thumb with charity trustees and their investing is to remember that you're investing through the eyes of the charity, through the lens of the charity. So try to put aside any personal considerations and look through the eyes of the charity. We have an interesting way to tackle this or to start the conversation. We have a little questionnaire which we can provide to trustees, and for example, they may have 3 or 4 people who have been maybe an investment subcommittee, or just 3 or 4 people who are going to be responsible for dealing with the investments of the charity. And we would give that questionnaire to all 3 or 4 of those individuals and ask them to complete it individually. And the questions in the questionnaire are trying to tease out how you can deal with falling markets. What's your attitude to risk? How nervous would you be in this year, for example? And it's similar questions asked in different ways. And then we can take the results of those answers, I think there's about 10 questions, and we use some software, which then out of that will provide us with where you're sitting on a scale of 1 to 6. Now, if all the trustees come out in the same place, that's always very helpful because there's obviously some common understanding as to what the attitude to risk and how accepting of risk you are. If they don't, which sometimes happens, then it's a case of sitting around the table and understanding why people answered in such a way. If we think of a scale of 1 to 6, and we have 6 steps in that scale clearly, just going to the second part of Linda's question, very few, if any, charities are in number 6, the highest risk. They just don't feel it's appropriate to be in the highest risk type of portfolio. Some will be, maybe some which are very large permanently endowed charities can be in that level because they feel in the way that their spending patterns are, they can cope with that, but very few. And if we think of a scale of 1 to 6, I would say very much the most popular, or the landing point for our questionnaires and our discussions tends to be a number 4 or a number 5. So just above the middle tends to be, but you're absolutely correct. As a trustee, thinking very hard about what your tolerance for risk is, what the organisation's tolerance for risk. You always have to be thinking about treating your future beneficiaries fair and equally to your current beneficiaries. So you don't want to be taking excess risk that's going to put that potentially as not being able to be achieved. Risk is such a small word that has just such a large impact and has a large range of understanding as to what that means, and that's really where you need to sit down and have a conversation and really make sure that trustees understand what the investment markets can and cannot do for them. Are there extra governance requirements for charities who invest? Typically, we will find that depending on the size of the charity, or maybe the number of people involved, maybe not necessarily the monetary size, typically there'll often be a subcommittee of people who will be responsible for communicating with the investment manager and reviewing and meeting and understanding performance, and they will then report into the board. So that's one governance structure, having an investment subcommittee who deal with investment matters, and they feed into the board. The other good governance point is, if you are investing as an organisation, to put together what's called an investment policy statement. And again, that's something that we can certainly help with. It's a trustee-owned document. It's a short 2 or 3 page document that lays out your rationale, your reasoning, what you're trying to do, how does investment fit for your charity and your organisation? Do you have any ethical considerations? Do you want to invest, particularly target positive allocations to renewables? Do you want to avoid tobacco? All of these questions that you would have as a conversation with your investment manager, put together an investment policy document, and that's a really good governance document for any other stakeholders. Make sure that you as trustees, we as investment managers, we all know where we stand, and we all know what the job at hand is all about, what the investment means to your organisation. So I would say those 2 things, potentially, not always, an investment subcommittee, and then an investment policy statement to detail your thoughts and objectives and all of those other factors to take into account. We have quite a nice little guide on investment policy statements. Sorry, Tracy, on our website. You can find there, or please do get in touch. I'm trying to think if we did an investment policy statement webinar, Tracy, but I could be mixing up which ones I've done where. But I think we might have done an investment policy.
Yeah,
I think we did.
I'll have a look, and if we did, I'll put that in the link for the email that we send out. Yeah. So people can have a look at that. And as we've said, if you think of any more questions, do get in touch with us via the link that I'll put in the email as well, and that will take you to Fiona for a chat about any issues or questions that you have. But if there's no more questions, then we'll probably wrap up now. Before I go, I'd just like to highlight our next Good Governance webinar, which is the same time next Wednesday. And there we're going to look at running a charity, and we'll consider key events as a charity develops, such as moving into premises, taking on staff, entering into contracts. And we'll be joined at that one by Gillespie McAndrew, one of our pro bono service legal partners, and also Oscar. So I hope you can join us at that. There should be a link there if you wanted to book onto that. And it just remains for me to thank Fiona very much for what was an excellent presentation, lots to think about. And just to say thank you all for joining us.
You're very welcome. Thank you, Tracy. And please do, if anybody would like to pop along to our trustee training session in our lovely shiny new offices in George Street, and we've been in there a few months, please do be more than happy to welcome you to that.
Great. Thank you.
Thanks very much.